Let's see if we can get Dr. Brad on. He is a financial planner and psychologist. Let me see if I can send him an invite here. Invite. Let's see if he jumps on.
And that's why we got him on here. What's up, Colin?
Hey, Dr. B, what's happening, man?
Good to see ya.
Where are you in Colorado right now?
I am. I'm in Boulder, Colorado.
Nice. And you were born and raised in Detroit? Is that Michigan?
Yep. I was born in Detroit. I was raised in the suburbs. So yep. How about you?
Yeah. So
you're in Michigan?
Yeah. So I'm from Michigan originally. I currently live in LA.
Okay. Yeah, I had some West Coast vibes, but aren't you still involved in Michigan? FPA or something? I think I saw that.
Yeah. So thanks for the shout out the other day for the FPA of Michigan. So I joined the board, and then when I was living in Michigan, and then I moved out here, and during the pandemic, everything was virtual. So they're like, Can you just stay on and like still help us out? And right now I am getting some committee chair members for the next gen community to kind of help me with facilitating in-person events.
Got it.
I think probably by the end of this year, I should just step down and hand off the reins. It's been 3 years, and they deserve someone full-time in person. But
sure.
So that will be kind of a bittersweet moment.
All right. Well, not to bore everyone to death because they don't love the FPA as much as we do.
Yeah.
I got some questions coming in here. So I want to get to know you a bit, and then also let's just tackle some of these. So my buddy Jonathan says, how do you approach short-term goals? Do you use CDs? What are your thoughts on that, Colin?
Ooh, that's a good one. So what I have set up is the stair step system, and it's basically based off time horizon. So I kind of put things into different buckets. So a 1 to 2 year window, a 3 to 5 year window, and then kind of my 5 year plus money. And the reason for that is that I hate money getting 0% rate of return just as much as anyone else. But as you know, Dr. B, the market is a scary place in the short term. If you're looking on a day-to-day basis, the market's only up like 51% of the time, and it feels like you're going to a casino. But if you extend that to a 5 year period, I don't care if you're talking 2015 to 2020 or 1945 to 1950, any 5 year period for the last 100 years, you're now up like 95, 93% of the time. And if you extend that even further, you have never lost money in the market ever. So it really does depend what time horizon. So if you have short term, to answer the person's question, cash is king if you're less than a year. If you're over a year, I do have one little trick, and it's the I bonds. I don't know if you've heard of those, Dr. B. They've been getting some attention the last little bit. So if you go to the treasurydirect.gov website, it's the only place you can buy them. Unfortunately, you can't get it on Robinhood. You can't get it on any other brokerage platform. The direct.gov website, you can get inflation bonds that are backed by the government. And just the other day, they came out with the new 6-month yield, and it is 9% guaranteed.
Woo, you hear that, everybody? 9% guaranteed 6-month yield. Is that like annualized?
Yeah, so you'd get
so it'd be about 4.5% for guys. You hear that, everybody? It's an excellent piece of advice, and I totally agree with you. Those numbers are really exciting to see. Well, it's actually kind of scary to see those numbers because you know what's happening, right? It's not good news. But I absolutely agree with you. It's so important. Over any 10-year period, like obviously, and even 5, as you mentioned, like you're great in the stock market. You need it a year or 2 from now. It is scary. It is really scary. And if you don't have that long-term mindset, you are going to make a mistake. The stock market's going to drop 50%. You're going to sell. You're going to lock in your loss. Then you're going to be scared. You're going to have your money on the sidelines. Maybe you swear off investing the rest of your life. Unfortunately. And then what happens is the market's then going to recover 30%. And then you're going to be like, oh no, I'm missing out on the upside. So then you're going to go in, and then you bought at a high again. And then you're going to start. Anyway, this is how normal human beings approach investing. And it's absolutely terrible.
Yep. And it's so counterintuitive, right?
Yep, absolutely. Yeah, but it makes sense if you think about our evolution and our biology. It's like we're all scared little deer, watching out for predators, right? So It makes sense why we do it, but this is why markets go up and why they go down and why they've been doing this forever and why the average investor does a terrible job, does an absolutely terrible job. They've done studies, and I know you know this because it's really kind of fun, but they've analyzed dead people's portfolios, and what they find is that if you're dead, you do better investing than if you're alive, because if you're alive, you're going to be, have you seen any of those studies, like looking at some of those accounts?
Yeah,
So
I think Fidelity
approach
does a good
investing
one.
like a dead person.
Less is more. I've heard a good
Absolutely.
analogy. Your investment portfolio is like a bar of soap. The more you touch it, the less there is.
I love it. It's totally true. So I got another one. Boxer Mom says, what do you think about crypto in retirement portfolios? I have some thoughts, but I'd love to hear yours, Colin. What crypto should we buy? When we're done with that, tell us all.
Yeah. So this is not advice. Any disclosures out there? I do own some Bitcoin. It's in my gambling account. I don't buy a whole lot of individual stocks, and when I do, it's more of a fun betting game for me. It is not a wealth building tactic. I rarely ever gamble at the casino or anything like that. So when I am looking for some entertainment, I just buy and trade a couple stocks here and there. But for crypto, I do, to a certain extent, believe that having a small percentage of your portfolio in some crypto is a reasonable diversification tool. Now, how you hold it is a really good question. I hold it in two ways. So there is one kind of ETF out there. I'll see if I can actually look up the ticker, and I put that in my Roth IRA. That was one option. And then the other place I do it is just through Coinbase, which is like the hard wallet, actually holding the spot price. The stinker about the ETF there is that it is an IOU. You really don't own the actual Bitcoin. You can't go out and, purchase something with it. You don't have a hard wallet. So, for example, there's days where Bitcoin is up, but my ETF trying to represent Bitcoin is actually down. So there's always a little bit of a difference between the actual asset price and the stock ticker. But I do own just a tiny bit. I don't believe you need it as a wealth building tool. If you want to dabble for some diversification, just be smart, be safe, and don't put too much in.
I love it. That's fabulous stuff. So I do believe also in cryptocurrency as being a legitimate asset class. I absolutely do. I will say, though, that in the last year and a half, I think we've gone from about 5,000 cryptos to 18,000. So it's like there's a lot of these cryptos that are going to go to a big fat zero. And I don't think there's any rash way to think about it otherwise. Like, I mean, it is the Wild West. 99% of them are going to be worthless, is my guess at some point. And do I own crypto? Yes, I do. And do I own one of those coins that's probably going to be absolutely worthless? I do. I'm not going to tell you what it is because I wouldn't want anyone else to get involved in this, like, just, garbage coins. But again, for me, it's gambling money too. It's like, it's probably less than 0.1% of my investable assets. And if you look at the volatility around cryptocurrency, no financial advisor who, has clients that they love would suggest having like a significant percentage of your net worth in cryptocurrency just because of the volatility. And that could all iron out over the future. This could be the future of money or not. But I have a feeling that it's a legitimate asset class that'll be there for many, many years to come. But I would be really hesitant to put a lot of my money into it because I actually like my money. I actually, in my firm, Colin, we actually do individual stocks. Okay. And people are like, well, but what about the market? I mean, we've been fairly fortunate to be in that small percentage that beats it risk adjusted. But we also spend like an obscene amount of money in research on from third parties to put that portfolio together. It's definitely loaded towards dividend producing stocks also. And we don't do a lot of trading in it. But even so, I feel like I always struggle with people asking me what to invest in. Like, and the answer I always give, Colin, and you'll appreciate this. You tell me if I'm violating any guidelines. Because I'm regulated by the SEC. All right. So here's what I say. I can't tell you what to invest in, but the SEC on their website talks about target date funds, and target date funds are a basket of stocks and bonds. They give you wide diversity across a bunch of different asset classes. And
Mm-hmm.
I think it's a really viable do-it-yourself option that people should research. And I will tell you this too, you tell me your opinion, but I think that the people who approach a target date fund are going to outperform like 99% of everyone else you see on TikTok and every other investor on the planet who's trying to beat the market. What do you think?
I couldn't agree anymore. I was actually just looking up a couple here, if maybe I could even like share my screen and kind of just give people a quick understanding of what we're even talking about. I mean, just for short, target date funds are basically designed to put together a diversified portfolio for you with just one ticker symbol. So you don't have to go out and buy and have lots of different holdings and think about 20% here, 10% there. You already lost me. So this is just kind of a quick one-stop shop, get you diversified, and hopefully, especially if you're in some of the Vanguard or Fidelity has some good ones, super low-cost option to gain access to that diversification. And then they're automatically updating that for you, because the stinker is about individual holdings is that you have to be really proactive. You have to be rebalancing them. So if you put 20% here and 20% there, you're going to turn around and the market's going to be all out of whack, and then you have to be on top of it to go and readjust things. The target date fund is going to do that for you. So I completely agree with you, especially if your alternative is going out and spending a 1% fee for an asset management service, and maybe that's the only value that they're providing, and then they put you in some expensive proprietary mutual funds. Net of all the fees, I completely agree with you. You're probably better off just going out and getting a low-cost target date fund.
Yeah, and those mutual funds, oh my goodness! Like I'm a huge fan. Like in our portfolios too. Like we do ETFs to cover all the areas, in most of our portfolios, right? And the other thing that kind of gets me on the social media investing advice is when people say, just buy the S&P 500 and an ETF. And by the way, I actually love that approach for large cap US stocks, right? Large cap US stocks, an ETF that represents the S&P 500 is going to be just about everybody on Wall Street, just so you know. My problem is, though, that that's only one asset class, like even within equities. What about small US stocks? What about mid-size? What about micro? What about international equities, small, big, large, developing countries, emerging markets, established international funds? So for me, I feel like we're not giving enough credit to good investment advisors who are able to, even though it has that buy and hold strategy, you're making tweaks in the asset allocation. You're not, for example, the bond market is a great example. Like, I mean, how many people, like if you really held to a buy and hold model, then you'd have people in large, long-term bond funds, but is that the right place to be the last 10 years, So,
or especially lately.
Yeah, lately, right? So that's where I get irritated by personal finance creators who are just saying, oh, just get an ETF. It's like, well, there are hundreds of them that represent lots of different asset classes. And that's why I always talk about the target date fund for do-it-yourself.
Yeah, I totally agree. Just for context there, when you look at the global market, it's kind of a wonky number, but the total value of all the publicly traded stocks in the world is like $90 trillion. And only about 55 to 60% of that is in the United States. So if you buy, and only a percentage of that is within the large cap funds, which you just mentioned are represented by the S&P 500. So when people say go buy the market, aka the S&P 500, you're missing out on 40% of global and a large percentage of the mid and small cap funds. So you're only getting a sliver of the global portfolio. So you're totally missing out. And does the S&P 500 do great? Yeah, you'll probably be fine. But there's times when the US is doing bad and developing markets are doing great.
Right. Let's see here. Somebody says, nice hat, Dr. Brad. I appreciate that. Am I like Ken Fisher? I don't know. I mean, I've heard some stuff about Ken Fisher. I think in many ways I am not like Ken Fisher at all. But in some ways I probably am. I imagine, I think he owns a registered investment advisory and doesn't make commissions, that kind of thing, fee only. So I'm like that in that sense. Jonathan also says the only issue with target date funds is the age is it puts you bond heavy. And I will agree with you on that, Jonathan. So a lot of times I've talked to people and recommended, when I know them and their situation and they want to do it themselves, to pretend they're a little bit younger when they're selecting it. The other thing too is, like, unless you've been investing for like 20, 30 years, you probably have a negative association with bonds, and not really thinking and knowing that there's significant periods of time throughout history that bonds have just utterly destroyed equities in terms of returns. And we just haven't been in that phase for quite a while, but we will again at some point. And so that's why, pretty soon there'll be a time when everyone's talking about bonds are the best, equities suck. And there have been periods in history, if you look back, where like 5 to 10 years periods of history where that's absolutely the case. And people were much more invested in bonds than equities. So anyway, that's my thought on that. What do you think?
Yeah, it's having a reasonable mix is great. And the target date funds do kind of have, that's maybe the biggest fault with them, but that is, when it comes to the lesser of the evils, still a big fan of the target dates. I actually have one pulled up, but I have been struggling to figure out, okay, flip the camera here. Okay, so I don't know if everyone can see this, but I'm just picking on Vanguard. I have zero affiliation with these guys, but this is just a fun one for as an example. And the first thing you're going to notice here is the expense ratio at 0.08%. So
Ooh,
if you have,
I love the sound of that.
Exactly, man. If you have $1,000 in here, you're paying $8 a year to gain access to some awesome diversification. So if we take a look at the portfolio, let's see how many bonds, what percentage of bonds do you think is in a 2060 fund?
It's got to be a low percentage, right? I mean, what, 10%, 15?
10%.
There you go.
So, I mean,
I don't think that's too heavy. Yeah.
I don't either. I don't think that's too bad at all. And look at that, 53% US, 35% non, a little bit of cash, probably for some rebalancing. I mean, this thing is probably holding, if we go to the fund, I wonder how many holdings it actually has. So it is holding, okay, so it is holding all of these different ETFs for you. And each one of these ETFs probably has thousands of stocks in it.
Right. It has international exposure too, doesn't it?
Yeah, so international was 35%.
There we go. That's pretty close to what it should be in terms of if you want diversification across the world. The other thing too you'll notice is when equities start to dump, people, it's sort of like a shell game where the money's going to go somewhere, right? And so when equities start to dump and people get real bearish on them and they get hurt and they're traumatized, what's going to happen is all that money is going to go into bonds. Okay, now, regardless of the interest rates, what's going to happen is those bond prices are going to increase because more people are buying them. And so that's an interesting thing. And a lot of what people try to do with market timing is try to guess what's coming next, and it's impossible to do consistently over time. That's why I want to be in everything. People ask me, should I invest in real estate? I'm like, yes. Should I invest in small? Yes, absolutely. I think you should own all of it. And depending on your risk tolerance, depending on your goals, you'll have a different asset allocation in all of those classes. But I think you should own all of it because that money's going to be shifting around forever.
Curious, Dr. B, what do you think about kind of the whole fintech space and how they're kind of financializing, if that's even a word, all these different almost new asset classes like wine and art and things that you could argue are an asset, but maybe not the traditional asset. I think one approach is like, hey, if you buy all 10,000 companies, 10,000 of the greatest companies from around the world, you're going to gain exposure to that stuff. However, maybe there's a couple asset classes out there that are a little bit outside of that. What says you?
Here, hold on, smile. I'm going to take a picture here. There we go. That'll be on Instagram later.
Awesome.
I really don't have my finger on the pulse there, but I'll tell you what comes up for me. There was this thing called subprime mortgages that people started to package together and sell, and I feel like there's a few things that are potentially dangerous about it. Number one, there's a lot of cost that goes into that, right? So you're not even getting exposure to the actual potential appreciation because somebody's making money by cobbling all that together and then selling it. So I think you're one step away from enjoying some of the benefits. I mean, I'd rather own companies that make wine, which you can get exposure to in a lot of these ETFs. So that's the only thing that concerns me. The other thing is it makes sense marketing, right? Like I think I got somebody just contacted me and asked me to be an influencer for one of these funds that puts together fine art, right?
Yeah.
So I think that it's interesting, it's exciting. I'm not sure what's going to happen with those. There could be appreciation in them, but we'll see how many are around 10 years from now, right?
Totally. I got a little bit
What
of
do you
flack.
think?
Yeah, so I guess I think it's more of an ROE, return on entertainment, than return on investment, because it's one of those things that's kind of fun to talk about, maybe more than it actually is a wealth building tool. I think it's kind of like the Bitcoin conversation. Maybe it's a little bit less of a legitimate asset class than Bitcoin. I guess it depends on who you ask. But I think having a little bit is fun. I have a lot of different brokerage accounts just because I genuinely enjoy learning how those platforms operate.
Right.
So I dabble here and there, but again, I don't have it as part of like my fundamental financial independence plan.
Got it. Yeah, I love that. I love how you've separated that into sort of your gambling fund, and then the one that's going to get you across the finish line. And because what we know throughout history is like it's the funds that you're going to lose all your money.
Yep.
But I also have that same sense too. Like I like to be in the action a little bit. Like when I go to Vegas, guys, I actually gamble. Again, it's money that I'm ready. It's entertainment money. I do it just for fun. I know I'm going to lose it all. But I actually have fun living in the possibility and the fantasy. It's probably because I grew up lower income too, of like, oh, this is it. I'm gonna strike it rich. And just honoring that is actually okay. It's okay. You got to build it into your plan though, and just be extremely disciplined around it, and not keep doubling down on a losing investment, right? So when you buy your crypto at the peak of the market, when everyone's all excited about it, and then it drops to 90%, you got to sort of calm down and not try to buy more of it at that rate, even though you're thinking, oh, buy low, because you've already allocated your gambling money and you just went through it. You know what I mean? So you got to be really disciplined.
Absolutely. I had another question. Oh, I was going to say, I got some flack for this here, but on TikTok, as you know, there is a ton of terrible financial advice. So it's been kind of fun for me, and that's really why I'm even on this platform, is
Me too.
It's like a challenge of like, how can I make good advice, good education rather, entertaining and consolidated into 10 seconds.
Right.
And so in the name of that, I asked Twitter actually, what would be your best piece of advice? And I made a video the other day saying if I could only get, I have 10 seconds and all of TikTok is watching, they have to implement this one piece of advice. What do you say? And I said, setting your 401k to 20 to 30%. And just having that money being siphoned out of your paycheck and learning to live on everything else. And a lot of course, advisors coming out of the woodwork and saying, oh, that's terrible advice. You can't gain access to it, all this other stuff.
Wait a second. Like, not advisors are saying that. Are you insurance salespeople?
Probably, realistically. Let's be real. I mean, it's username 110025
Right.
who comes out and says, your advice is terrible, blah, blah, blah. Curious what you think about that, if that's the one piece of advice, and then what would yours be?
Yeah, so I think I grasped what you were saying. For me, it's definitely, I mean, I'm always trying to make it sexy too, right? It's pay yourself first. I mean, and I love 30%. That was what I did. I just, right off the top, it's 30% of every dollar I make. And people say net? No, gross, like 30% gross.
Mm-hmm.
At least went into my financial freedom fund. And sometimes that was a simple IRA. Sometimes it was a Roth IRA. But for the majority of my life, it's been a 401k, just maxing that sucker out. And then you know, I've been blessed. So sometimes my 30% is beyond the 401k. And so then I put it in a trust account or a brokerage account, and I just keep cranking away on it. So it's a really strange meme. You know, I just put one on, did a video on a 401k. You know, it was actually a shot of the Colorado Rockies. And I'm like, you know, there's only one person in here who hasn't fully funded their 401k. You know, can you pick who it is? Just as a joke. And then I get these comments saying, I'm always trying to like tell people they should do that, right? I'm trying to find creative ways to do it. And somebody's like, 401ks are terrible. You can, and they talked about losing all their money. 401ks are a terrible investment. Okay, guys, a 401k is not an investment. Okay, not at all. Like, it's an account. It's a very advantageous account. And it gets it's bizarre to me. Like, I'm still trying to wrap my head around why people are against a 401k. And like, I own my own company. And the first thing I did was set up a 401k for myself and fully fund it. It's all it is an account. It's an account that's advantageous. It saves me money on taxes. Since I own a business, I can actually match my 401k, so I can put crazy amounts of money in there. And it's something that if you don't, a lot of people have access to it in your company for your employer. First thing I would do, get a job, max out that 401k. I totally agree.
Yeah. Awesome. All right, so we're at least aligned there. That if you could do one thing,
isn't every
it's
CFP like this is the crazy part. Like, what you and I consider just normal advice that frankly, all millionaires, self-made millionaires have done. It gets this crazy stuff on TikTok where it's like, that's dumb, that's stupid. And I got to just pin it all down to poor mindset, to be honest. Like, it's a get rich quick mindset. It's a poor mindset. And it just keeps people poor. It makes me sad. It's why I'm on this app making videos, to be honest.
Me too, man. Me too. Have you ever met Brendan Fraser by chance? That's who I had on as a guest for the Financial Planning Association last week.
I've heard of him. Yes.
Wired Planning. He's very much into the behavioral financial game. Not as much as you are, but you would be like you two would just get along really well.
That's cool. Oh, I got somebody here saying, because if it's attached to the market, then the market could crash for 20 years. Now, I think that's a really, really important point that you just brought up. And I will say this, though, people rarely have 100% of their money in like equities, for example, or, I mean, as a matter of fact, most advisors would suggest you not do that. Like, there's poorly constructed 401ks for sure, because people get to choose their investments inside of it. That's where education around investing is really, really important, because a lot of these, you choose them for yourself. But the bottom line is that, as Colin said, like, over a 5-year period, you don't lose money, or 10-year period, you lose money over time if it was all in the market. People lose their money because it crashes and then they sell. And the bottom line is, if you need this money within the next 10 years, I wouldn't put it all in equities. I would spread it around. And 100%. I run this with my clients too, right? So, we manage about $500 million, and I've got wealthy people who care about their money, right? And they're concerned when the market goes down. And one of the ways to look at it, you talked about buckets, and what I do is I pop up an equity bucket and a fixed income bucket, which is their bonds. And if you've got someone who's older and they're needing some of this money, quite often you have it diversified into bonds also. And in the midst of the crisis, the last crisis we had with COVID, the stock market was down 22%, I think at its worst. And I ran a report and I showed, hey, look, here, your equity side is down 22%. Your bonds are only down 2%. And we could theoretically live off your bonds for the next 10 years. We wouldn't even need to tap into your equities. And that's the way a solid portfolio is put together. It's with the idea of, when am I going to need this income, and plan for it in terms of your investing strategy.
Mic drop.
So you would agree?
Absolutely. Just had a question if the Vanguard Retirement 2055 fund was a good one to pick. Not sure how.
Yes.
Yes, I guess. Yeah. Quick answer. Yes.
Yeah, it depends on, when do you see yourself retiring? I mean, the idea there with those funds is that you're picking the year in which you're anticipating retiring. It's going to adjust for you over time. But, this is where you get to go in there and look at your risk tolerance a little bit. Like, I think that's a really important factor too. It's not just the year. It's like, do you want more exposure to equities, less, so you can toy around plus 5 years, minus 5 years? I think that's totally fine. Crypto to the moon. Yes. Has the moon been on the bottom of the earth for the last few months? Because sometimes, to the moon, yeah, because it's kind of been like this.
It's going down.
And Hey, Colin and I are we have exposure to that asset class, so we're with you. You know, like, woohoo, that'd be great.
Yep.
But there's no guarantees. There's no guarantees. And as I mentioned too, there's 18,000. I just looked at Coin Market Cap. I think it's over 18,000 crypto coins right now. 18,000. Do we really think there's 18,000? We need 18,000 currencies. Is that what we think we need? How many digital currencies do we need? That's the question. And my guess is like 10, 20 years from now, there'll be like 10 or 15 of them, or 20 maybe. I'm like, I don't know. Who knows? But 18,000, I don't think so. So good luck.
That is wild. I had no idea. That's so many.
It really is. Well, Colin, I got to bounce here, but it's been so much fun chatting with you. I think we've been trying to do this. I'm glad we were able to do it on the fly.
Yes. We'll probably get another one on the fly here sometime.
Let's do it, man. I'm happy to do this with you as often as possible, because I just feel like we need the CFP voice on this platform, because there's so many, like you and I, we work with people around money and investing, and we work with wealthy individuals. We know what's up. We know what's really happening. And a lot of people, if you're not exposed to that, you have misinformation around what people actually do. And so, and TikTok just makes it way worse, frankly. So I'm glad to see you on here.
Thanks, man. And you've been a huge inspiration for me even wanting to get more involved. It's like, at least there's one light on here. So hopefully we can try to spread that light out and make it brighter. Maybe make this platform actually a great place to find financial education.
Yep, I agree. Well, thank you, my friend, and we will chat again soon. And goodbye, everybody. Have a good weekend.
Great talking with you.